everyone, in this series we will be covering all the asset-based Indian accounting standards, and today is the day for Indian Accounting Standard 2, Inventories. First of all, we need to know the definition of inventories. Inventories are the assets that are held for sale in the ordinary course of business, or in the process of production for such sale, or in the form of material or supplies to be consumed in the production process or in rendering of services. It is clearly given in the definition that inventories are the assets held for sale and not for use. And if it was held for use, then it would have been covered under Ind AS 16. So in short, we can say that inventories are finished goods or work in progress or raw materials which are to be consumed in the process to convert into finished goods. So how we will measure these inventories? From our IPCC days and accounting standards also, we have learned that inventories are measured at lower of cost and NRV. And Indian accounting standards also says the same thing. That is, it will be measured at cost or NRV, whichever is lower. Let's understand the term net realizable value. It is the estimated selling price in ordinary course of business after deducting the estimated cost of completion and estimated costs necessary to make the sale. In Indian accounting standards, in every standard we will find a term fair value. Broadly, the two look the same, but actually net realizable value is an entity specific value and fair value is not. So NRV and fair value may not always be equal. Now let us see the elements of cost of inventories. It comprises of cost of purchase, the conversion cost, and all the other costs that are necessary to bring the inventory to present location and condition. Cost of purchase of inventory includes the purchase price, all import duties and other taxes which are non-refundable, transport and other handling charges, after deducting all the trade discounts, rebates or other similar item. Here there is an important point to be noted that we will only deduct trade discount and not the settlement discount or cash discount which are offered to the customers on prompt payment of inventories. Then we move to cost of conversion, which includes direct material, direct labor and other direct cost, and also all other indirect costs which we call overheads. Life was simple till we are asked to calculate direct cost. We can simply multiply number of units into cost per unit and add it to the cost of inventories. Same is the case for variable production overhead, but for fixed production overhead, we will have to check the normal capacity. And if it happens that normal capacity is more than the actual production, that is, it is a case of under absorption, then in that case we will have to find allocated fixed overhead. For that, we will have to first find out the cost per unit of fixed overhead based on normal capacity and not the actual capacity, and multiply it with actual production. This figure will be equal to the allocated fixed overhead, which we will add to the figure of inventories to find out the cost of inventories. And the remaining amount, that is total fixed overhead minus the allocated fixed overhead, will be expensed off to PL. So this was all about what are the costs that are to be included in the cost of inventories. Now let us see one by one what cost will be excluded from the cost of inventories. Abnormal amounts of wasted material, labor and other production costs are cost of abnormal nature and will not occur every time. So these are to be excluded from the cost of inventories. Storage cost, administrative overheads and selling cost are also excluded from the cost of inventories. These costs do not directly contribute to bring the inventories in the present condition and thus they are excluded from the cost of inventories. But if the storage cost is necessary in production process before the further production stage, then in that case, that cost will be included in the cost of inventories. Next, we move on to the section of allocation of cost to joint products and byproducts. In a production process, it may so happen that more than one product is produced. If the outcome is a joint product and the cost of conversion is not separately identifiable, then in that case, we will have to allocate the cost based on relative sales value of the product and not the sales price. If the outcome is main product along with a byproduct and byproduct is material, then we will have to treat the byproduct as a joint product and accordingly we will have to do the treatment as discussed now. If the byproduct is immaterial, then in that case, we will have to measure the byproduct at net realizable value and then we will have to deduct this net realizable value from the cost of main product. There is an important question given in the material where byproduct and joint product both are produced. In that case, we will have to assume that byproduct was immaterial and so we will have to deduct the NRV from the cost of main product. And after that, we will have to allocate the cost to each of the joint products. This Ind AS also requires to review the raw material if the entity writes down any of its finished goods. Materials and other supplies to be used in the production of inventories should not be written down below cost if the finished goods are expected to be sold at or above the cost. But if there is a decline in price of material which indicates that the cost of finished products will exceed the net realizable value, then in that case the material should be written down to its net realizable value. About cost formula, entity should use same cost formula for all inventories having similar nature and use to the entity. So if you are asked the question that there is an entity which is having inventory of similar nature and use to it but is using a different cost formula because they are at different geographical location. So our answer should be no, that if an entity is having inventory of similar nature and use, then in that case it will have to apply same cost formula. And geographical location has nothing to do with it. There was also a question in Institute's material where it was asked that whether primary packaging material and secondary packaging material are to be included in the cost of inventories or not. Primary packaging material are to be included in the cost of inventories because these brings the inventory to sellable condition. But secondary packing material do not bring the inventory to selling condition, and these are in nature of selling cost, and therefore it should not be included in the cost of inventories. So I have covered all the parts of this index. Rather, I would say that I have covered everything which Institute wants us to know. After this, try to solve all the illustrations and questions of test your knowledge and you will be covered with this index. And yeah, don't forget to subscribe to the channel and put down your comment below. Till then, bye bye and have a good day.